Most traders have used the Fibonacci tool at some point. You pull it from a high to a low and your chart is covered in levels, such as 0.382, 0.618, 1.618, which is called golden ratio. Honestly, it looks powerful. It looks like it works. Every time price hits one of those levels and reacts, it feels like Fibonacci tool just called the move like it knew. But I want you to think about it for a second. If you draw enough lines across any price range, price is gonna touch something. But that's not prediction. That is just possibility working in your favor by accident. Traders start making decisions based on the levels that don't actually mean anything. They get positioned and market takes them out. All these positions turn into liquidity for the market. So Fibonacci levels are mostly noise. It doesn't just confuse you, it turns you into liquidity. I spent years going through charts, trying different approaches and simplifying. And I kept coming back to one level that actually made sense to me. And that is 50%, the midpoint of a range. No fancy ratios, just the middle. It is simple, maybe too simple, but simple is what works. Let me show you exactly what I mean. So here is our target corporation price chart. Before you use Fibonacci tool, first you need to define which range you will use. In this price chart, you can see this is specific high and here is our specific low. So from this high till this low, you can drag your Fibonacci. So by default, Fibonacci tool looks like this. It's colorful and it has all the Fibonacci levels. It also goes above the range. But I personally don't use any of these levels because it creates a lot of noise. If you have these levels on your price chart before you analyze, it just creates confusion. So I have my own Fibonacci settings. 0, 0.5 and 1. So basically I don't use Fibonacci tool, I only use this tool to measure range. So when you measure your range, so you can see 50% of our range is here. So when I measure this main range, now I have two range. The first one is here, the upper portion of our range, and the second one is here, the lower portion of our range. Now I will measure the lower portion of our range. I apply the same logic. Since price was making reversal, I don't need to measure the upper portion of our main range because price movement is happening right here, lower portion of our main range. And now we have two more range. One is here, the second one is here. I will also measure the lower portion of this second range. You can see clearly on our price chart. Price is respecting all our 0.5 levels. First, we made a low here, and price directly aimed this 0.5 level, which is here. Afterwards, price lost midpoint of our second range, made intermediate low here. After getting rejected from this 0.5 level, it came down and took the sell side liquidity of this range. Normally the logic is you can expect price to continue to go down, but after getting rejected from this low, price continued to go up and gain all this 0.5 level of these ranges. And every time price crosses one 0.5 level, it aims the second 0.5 level. If it can manage to stay above this 0.5 level, it aims other 0.5 level. So basically the main logic is if price has enough momentum to stay above this 0.5 level of our ranges, it aims the next one. If it can't stay above this 0.5 level, it will show weakness and it will come down, and same thing will apply. So if it can manage go above this 0.5 level, it will continue to go down. So the real question is, why does this happen? So one possible explanation is algorithmic trading. So modern markets are heavily influenced by algorithms, and algorithms tend to operate using simple reference points within those ranges. So the midpoint is one of the most logical reference point. So you can think logically. These markets are controlled by algorithm because every time price needs to be delivered efficiently. These algorithms doesn't play against you. Their only purpose is delivering price, and defining midpoint is great indicator for catching asset that has great momentum. Another explanation is market psychology. The midpoint represents a kind of equilibrium between buyers and sellers. When price moves above or below it, it signals who is gaining control. So what I personally prefer is that instead of filling my charts with many Fibonacci numbers, I focus on the midpoint of ranges because it keeps the charts cleaner and reduce noise. And in my experience, it reflects how price actually behaves. Here is our second example. I will drag my Fibonacci from high to low. Even with one Fibonacci, you can see how price respects this 0.5 level here. And I will measure again the lower portion of our range. I don't measure right now the upper portion of our range because price is happening right here. And I will also measure lower portion of our second range, which is here. So you can clearly see again, price made low here, went up clean above this 0.5 level and came down here. So you can expect price to go down after here, but what price did here? Price had little reversal here. It went up above this 0.5 level, which is here. After regaining this level, price had a momentum. If price was weak enough, I wouldn't expect price to go above this 0.5 level. Because as I said previously, after regaining this 0.5 level, price aiming other 0.5 levels here. And this example explains everything. It came up until here. After rejecting, it went up again. After regaining this 0.5 level, it aims the 0.5 level of our main range here. And after price rejecting from this 0.5 level, it started going down. And you can still clearly see price respecting this 0.5 level still. Our third example is Northern Oil and Gas, NOx stock price chart. I will take this high and drag my Fibonacci up until this low. And I will again measure the lower portion of our main range. So price made low here, got rejected here after cleaning 0.5 level of our second range. Made its low here, had little reversal and regained this 0.5 level. So if price was here, I wouldn't be bullish on this asset because there is still chance that price can continue to go down and take this low and this low. But after I see price is trying to regain this 0.5 level, I see momentum incoming. You can also see it on the chart. After regaining this 0.5 level, price directly aims other 0.5 level, which is here. And same thing is happening right here. After rejecting from this high, price came down and cleaned the low of our 0.5 level. Here is first low, second low. I wouldn't be bullish on here, even here. Here it took sell side liquidity of this low. Let me zoom in. I would still wait at this low, but when I see price is trying to regain this 0.5 level again and staying above this 0.5 level, I can aim other 0.5 level as my target, which you can see clearly what price actually did. So you don't need to treat Fibonacci like a magic tool. In mathematics or in real life, maybe it means something. But in trading, this is just fancy tool that makes you liquidity. I hope you enjoyed this teaching. At the end of the video, I will add my trading strategies playlist. Make sure you learn them and combine with this 0.5 level logic, because this is what actually works in trading. You need to follow the logical key levels and where momentum is flowing. So don't forget to subscribe and like this video and share your thoughts in the comment section. See you next time.